Welcome to Investor Speed Run. Today we're breaking down Bridges Trust's Q2 market commentary. First, let's take a look at Bridges. In the last 5 years, they have modestly outperformed the S&P 500 and done even better in the last year, which is unsurprising given their top holdings in market commentary. Bridges Trust generally focuses on large cap stocks with a fundamentals-driven approach. You'll find the fund's fact sheet in the video description. Let's dig in. Bridges Trust takes a pragmatic stance on the mixed signals in the market. They highlight positives such as easing inflation and earnings performance, especially for the Magnificent Seven. They also discuss headwinds in consumer spending and lagging performance for the rest of the stock market. Bridges saw two big hurdles coming into 2024: inflation and corporate earnings. So far, so good on both counts. Corporate earnings have met what Bridges saw as lofty expectations. Plus, Wall Street analysts' 24 and 25 earnings estimates have held steady. We've also seen inflation continue its decline. On the flip side, consumer spending faces headwinds. Excess pandemic savings and rising financial assets supported consumer spending over the past few years, but consumers have worked through the $2 trillion in excess pandemic savings. Also seeing increased credit delinquencies and labor market cracks are emerging. This sets up a path towards easing monetary policy. With inflation easing and consumer headwinds, Bridges expects monetary policy to ease over next few years. The European Central Bank is a bellwether, lowering rates in June due to stalling growth in Europe. Bridges expects the same from the Fed in the second half of 2024. Recession or soft landing? The market expects a rare occurrence, a soft landing. This would be the second time since World War II where a Fed rate hiking cycle did not end in recession. Bridges hints at agreement with the market, at least over the short run. This would be the best possible outcome after the rapid tightening in financial conditions. Divergence in the stock market. The Magnificent Seven has buoyed the market with strong earnings performance, up 52% year over year in Q1, while the rest of S&P 500 declined 9%. These numbers have driven divergence in PE multiples, 30x and 16x respectively. This nets to a price-to-earnings ratio of 21 times earnings for the S&P 500, high on absolute basis but reasonable if earnings growth continues to meet analyst expectations. Bridges expects earnings growth of the Magnificent Seven and the rest of market to converge through the rest of 2024 and 2025. AI drives earnings optimism among analysts. Analysts' forward-looking earnings estimates, which justify the current S&P 500 PE, are largely driven by AI-related spending and efficiencies. Extreme forecasts for AI's impact should be viewed with caution, but the appealing cross-industry application for AI can serve as a positive catalyst in a mature economy. Let's wrap up with key areas to watch. Impact of Fed rate decisions. Do we see lower rates in second half of the year? Does this cause inflation tick up? What, if any, impact would this have on consumer spending? Earnings performance versus analyst expectations. Can corporate earnings meet reasonably lofty analyst estimates to justify the elevated PE multiple of the S&P 500? And a related topic. If Bridges Trust's call on the earnings convergence of the Magnificent Seven and the rest of market's earnings is accurate, at what PE multiple do they meet? That's it for Bridges Trust Q2 market commentary. A link to the full report is in the video description. Let me know what you want Speed Ran next. Just post a link to a report in the comments. If you enjoyed this video, subscribe. It is helpful motivation to keep creating videos. Happy investing and thank you for watching.